Hi, this is Tenagifford, and this is the webinar of being your own bank. The highly sought after information. We're going to run through this in under 10 minutes. So, this is a permanent policy. We're using a trusted carrier that was rated number two in the industry recently that we write for. We're going to use a client that is just 26 years old, someone that's preferred non tobacco with no health concerns. Right. While we're building this policy, we're going to make sure that there's certain particular parameters in place so that the be your bank concept comes out when we look at our preview. So guideline premium test is very important. That means that the government will not come after you, that the policy is set up where you're not going to overfund it and look as though you're using it as a tax sheltered vehicle, even though you may be. This is going to keep you safe, right? The death benefit amount is going to be what your family will receive or your beneficiary or your business will receive in the event of your death. And this particular solve type on this particular illustration, we're going to use minimum death benefit max cash value. Right? There's a lot of different solves, but for this be your own bank, that's what we're going to use. So here it's going to be year one to maturity, meaning until the person expires or dies. No, for the policy is not going to look for you to convert it or to renew it. No changes. This is going to be a permanent policy. We're going to leave the death benefit level, meaning that it'll stay the exact same amount until maturity, unless you overfund the policy and cause for it to grow. Next, we're going to look at the premium. So we're going to specify the amount of the premium at $500. Most people who are looking to fund the policy with the purposes of getting something out of the policy, they go $500 or better. Now, when I set up the parameters, we're going to put it from age, from year one to age 66. The person will not pay another premium after age 66. And then we look at the distribution portion. We're going to set this policy parameter up for them to be able to take tax-free loans solving for income from their policy at age 67 until the time they expire. Another important part of being your own bank, it needs to be at a fixed rate. So it's going to be a tax-free loan from your own money, hence the be your own bank concept. So there's different ways that it can be done. An agent that is not seasoned may pick variable, which could cause it to fluctuate and for you to not give what it is that you're expecting. A standard loan could cause you to have a higher rate based on the market and what the market's rates are for loans. Remember, the reason they're saying be your own bank is because you don't have to apply to take this money out. This money will belong to you based on how you fund it. So at $500 a month, we're looking at an annual outlay of $6,000. You have to fund it in order to get something out. If you don't put something in, you can't get something out. Now, a good policy will be built not only with the concept of you being your bank, but it will also have living riders, living benefit riders. If you become terminally ill, meaning that you're only going to live for 2 years, says the doctor, you have the option to take out up to 90% of the policy while you're living. Chronically ill, critically ill. Chronically ill could be that you can't do 2 out of the 6 things: dressing, toileting, eating, or so, and they will release up to 90%. Critically ill could be Lou Gehrig's disease, or could even be cancer. Doesn't mean that you have to die from these things, but you may want to access the funds to get the best care or even set up your legacy while you're alive. So here are the options that a good built policy will structure this for you to start at the ages that you want it to start at. These are not extra parts of your policy that you pay for. This is built into a good policy. All right. So these are, remember, living benefit riders. There's others that you can add. At times, people add a child term rider on. Sometimes it's $1 or $2, and you can get, up to maybe $10,000, $15,000, sometimes 25,000 per child. And you can add an additional person on as well with an other insured rider without a lot of underwriting. So these policies have details that an experienced agent needs to help you with. All right. The next part of the Be Your Own Bank would be setting it up to a strategy that will cause you to lose no money. There's something called a ceiling and a floor in a policy or even in an investment. The ceiling means that how high you can go. What is the highest percentage amount that you can receive? And the floor is 0 is your hero. You can't lose anything. So if we choose the S&P 500 point-to-point cap focus, you're not going to lose anything. They're using it as an index. You're not in the stock market. It's a fixed bank concept, and the loan rate stays fixed when it's time for you to take out your tax-free loans at age 67. So now we're going to take a quick view. We've built this policy. Now, remember, this was just an example. It's a strategy for somebody who's age 26. I'll do it again on part 2 for somebody who's a little older, ways that they can become their own bank. But this is for someone that's age 26, a male that's has no physical ailments or anything, and they're paying $500 a month, which is annually $6,000 a year. So let's take a quick view of what this would look like. All right. So this person would get a death benefit for their family of $500,000, $531,000, because they're only age 26. The probability of them dying anytime soon is very low. So this company is going to give them a lot for their family, because they're going to be paying this $500 in until they expire, right? So we take a look and we see that, remember, we set it up the way that we wanted it to set up. So you got $6,000 going in. The MEC premium is $24,000. So if you wanted to overfund this, you wouldn't be able to put more than that in without the government pulling your coattail. So it's going to tell you what that amount is. Now we begin to look at this policy. In year 1, the policy has accumulated value. No annual income, no loan amounts can come out, and you're paying a set premium of $6,000. It's not going to fluctuate on you because we have it set, right? Your death benefit is going to stay the same all the way for the first 28 years of the policy. It's going to stay the same. 26 years it looks like. And then the policy, because you're funding it at $6,000, is going to force the death benefit to go up higher. But what we want to look at is, where's the banking concept, right? We see that the loan option is 0, the annual income is 0. So now we're going to go down to age 66. Look at the 41st year of this policy. At age 66, there's no longer a payment due in the 67th year because you've paid in for the years. Now it's time for you to get out. So you'll notice in the loan column, you'll start to see money. And look in this column, there's an annual income that you can withdraw tax-free from this policy from age 67 to 100. So you can take $66,360 out of this policy every year tax-free for the rest of the existence of this policy. Now, one of the pluses is that the policy death benefit also went up. You'll notice that it started to rise because you were funding it so much, and this policy is growing so much based on this S&P 500 that it's going to also raise the death benefit. Where if you were to pass away at the average age of a male of 86, your family would receive $1 million. That's a great thing. It would change the legacy of the family. But meanwhile, there's $66,360 every year that can be taken out of this policy from age 67 to maturity. You don't have to apply for this money. You don't have to qualify for it. It belongs to you. This is how you become your own bank. Remember, this was only at $500 a month. There are people who spend more on Roblox and sneakers than $500 a month. Funding a policy like this is the way you would set yourself up for retirement with a fixed, remember, there's no floor to this. You can't lose anything. And there's a ceiling that can go high and it's going to cap you at a certain amount, but you don't have to really worry about it losing anything. Tenagifford, 1-888-485-1520. This was Be Your Own Bank, take one.